broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Hello and welcome to Bazaar Morning Call. You're watching us live from the CNBC-TV18 Motilal Oswal studio. I'm Sonia and today joining me are Mangalam and Ekta. Folks, the last 10 days of what has been a fabulous year for the markets, but now it's just dragging its feet, I mean, it's so hard to come to work, especially when there's so many festivities around. But you got to do what you got to do.
You got to do what you got to do. When you're traveling and you're reaching that destination, the last 15 minutes are the worst, where you're most impatient and you just want to get off the travel mode and start with your vacation. I think that's what everyone's waiting for.
Yes, absolutely. But for the Indian markets, this December has been the best since December 2017 in terms of flows. So actually, it's been extremely lucky for us. And I'm sure a lot of investors don't want this December to end. But nonetheless, all good things probably do come to an end. And next year, we have big queues lined up as well. The biggest one would be elections. So maybe, we should just take away the most from this end of the year.
Yesterday, Ajay Srivastava, we were speaking to him and he said that if you don't take time out this year, then you're doing yourself, you're not doing yourself a favor. So, I mean, this has been such a good year for the markets that perhaps it's just, important for you to sort of take that time out and go and enjoy the festivities.
Not only time, whether you should be taking profits out.
Yeah, that's a big question.
I don't know if any of you all watched the IPL auction. Speak about profits. Just the two players, Pat Cummins and Mitchell Starc, got 45 crores. And you know what's even worse, what feels bad? November 19, they took the World Cup from us. And December 19, they took 45 crores from us.
Okay. Okay, I didn't look at it that way actually, but thanks for making all of us now feel bad about it. But there's so much in the markets that we have to talk about. So it's holiday season, there's festive cheer, so flows have cooled off a little bit, as is the case generally towards the end of the year. So very quickly, let me just put some cues forward. I think the uptrend for this market is pretty much intact. There's no two ways about that. Things have cooled off a little bit because it's year end, but nevertheless, the Nifty yesterday consolidated above the 21,000 mark. And we, in fact, hit a record high, intraday record high of 21,500. So those levels continue to be scaled up in terms of, milestones. The flows have thinned out, but DI still bought about 300 crores, FI sold about 600 odd crores. But the US market action was quite strong actually overnight. So you had the Dow, which was up 250 odd points, and 9 straight sessions now in terms of, a big move on the Dow. So despite people perhaps taking some time off, there's still a lot of traction on the upside. The S&P 500, let's not forget, is just 1% away from an all-time high. So this has been a phenomenal year for the bulls. A couple of spaces that, to keep on your radar. The technology stocks could be in focus. I don't think this will come as a major negative surprise because we already know this. Accenture in their earlier numbers as well had talked about how discretionary spending is weak and they had muted revenue growth guidance of around 2 to 5%. So they hold on to that. This won't come as a negative surprise, but it just reiterates the fact that IT spending has not picked up or has not recovered as one would have perhaps thought, or as the stocks have been factoring in. So this is just something that could perhaps dampen the mood a little bit. But other than that, the winning streak continues. And I think, it's just prudent to stay with your long positions because there's no trigger to suggest otherwise.
I agree with you. It's been such a nice record-setting rally that any pause is nothing but a pause for breath. And that's exactly what's happened over the last couple of trading sessions as well, where the market's consolidating between this 21,350 to 21,550 sort of band as well. And that's yesterday's move as well. Classic, recovery from the lower end of the band. The low yesterday was 21,338, pretty close to 21,350, and the high was 21,505 itself. Now, the GIFT Nifty is suggesting that we open near the congestion zone. The question is whether it sustains above that or does it go back to, the middle end of this range itself. While the FI sold about 601 crores in cash market because of thin volumes, they bought around 1,300 crores in index futures on a day when the market consolidated. So that's a big positive. Their longs have inched higher from 58% to 62%. They added about 11,000 longs and covered 3,000 shorts as well. This range that I'm talking about is visible even in the options. We've seen a fair amount of writing at the 21,500 call for a premium of 50 rupees, a fair amount of writing at the 21,400 put for a premium of 50 odd rupees as well. The two key things to watch out for today, apart from the IT index, of course, will be the Nifty Bank because it's the weekly options expiry. And for that, we have the 48,000 call, which has the maximum open interest. So do we see a bit of a ceiling out there or not? And if we see a ceiling on the Nifty Bank and the IT stocks don't move as much as they did last week, what could be the next trigger? Reliance, could that be the stock that leads the next rally? Because the stock yesterday's move indicated it's at a 4-month high. It's still about 10% away from its 52-week high. But if you look at the heavyweights on the index, Reliance this week is up 4%. The last week we saw participation come in from the IT stocks, so they've been consolidating this week. And the previous week we saw a big move on HDFC Bank that has been flat this week as well. So is the momentum with Reliance is the big question.
Okay, yes, definitely. Reliance is probably going to help the markets move higher if it does at a 4-month high for Reliance. But nonetheless, just to reiterate what you guys said, that, the Nifty has consolidated for the past 2 days. There's a little bit of a quietening down which has taken place in terms of the markets. The mid-cap index ended lower by around 0.4%. So I'd really like to see whether that momentum comes back, corroborated with the FII flow. Because, yes, the FIIs have put in around 29,000 crores this month itself on a net basis, barring the last 2 trading sessions where they've been net sellers. So whether or not that continues and the trend to watch out for. Separately, what I'd be watching out for is the listing from DOMS Industry. My personal favorite, only because I use their products, but subscribed 93 times. So let's see what that, throws up. India Shelter Finance Management, it subscribed around 36.6 times, but the QIB was around 89.7 times. So that would be another listing to watch out for. And Azad Engineering, looking to raise around 790 crores, opens today. The only reason, one of the reasons for interest is Sachin Tendulkar, Saina Nehwal, VVS Lakshman are supposed to be investors in this particular company. So let's see, I'm sure that will be one additional point to watch out for.
Okay, so much to track, right, in the market. But the GIFT Nifty, by the way, is indicating a big start this morning. So I think it's about 80 points higher. Looks like, there's no quietening down of the market just yet. Perhaps that last hurrah before the end of the year. But let's get you through with some opinion for the day. We begin with Surendra Goyal of Citi, who says that the Indian market is trading at a premium to long-term averages in absolute and relative terms. He views multiple expansions as justified to an extent given India's resilient growth and the challenges elsewhere in the emerging markets. He says Citi's Nifty EPS growth expectations for FY24 is at 17% and 14% for FY25. And consensus Nifty EPS growth expectations for FY24 is at 20% and 15% for FY25. Going forward, he expects the base to become slightly unfavorable in key sectors such as financials and autos.
All right, let's get you some money market views coming in on the rupee first from Kunal Sodhani of Shinhan Bank. He says that dollar index is currently in the grip of a downward trend, heavily influenced by falling yields and dovish comments from the Fed officials, which fuel further easing bets as well. Brent crude prices continue to soar due to the rise in the Red Sea crisis. But for the USD INR, 82.95 per dollar acts as a support, while 83.25 is a bit of a resistance.
All right, and we have lots of stock-specific action to track today, and we'll get to it in just a bit. In our special Top 10 segment, we're looking at IT stocks, Varun Beverages, Nippon India, AMC, JK Tyre, UPL, Astral, BPCL, Petnet LNG, which are on our radar on the back of positive news flow, and Embassy Office Parks, REIT, and NBFC stocks on our radar that are likely to open in the red.
All right, well, let's kickstart the show with our first guest of the day. Dean Kim, the head of Global Research Products at William O'Neill, joins in now to talk about the markets. Dean, well, it's the last 10 days of the year, so I don't know too many people who want to talk about the markets. But be that as it may, it's been a phenomenal year for the bulls. Do you think we can repeat this performance in the first half of 2024? And how are the charts looking like now for something like the Nifty? Do you see us scale well above this 22,000 level?
Yeah, thanks for having me on. Basically, both S&P and NASDAQ are year-to-date highs. And actually, the next resistance is the highs established at the end of 2021. So that's when, sort of the bear market started. So we're glad to see the markets back up here. Now, in terms of where we go from here, I think we have to, keep a close eye on what's happening in towards the consumer. December is going to be a great month as retail forecasters are suggesting, record Christmas spending. However, when we listen to what people like Walmart has to say, they are seeing a bit of a slowdown in consumer. And we have to also remember that the yield curve continues to be inverted. So we still have, the question of, are we going to go through a soft landing or a hard landing? So that needs to be sort of digested by the market. But, right now the market is behaving like we're going to go through a bit of a soft landing. So that is good news. Certainly the market's not going to go straight up. So we'll probably see a bit of correction, perhaps in the first half. But as the Fed starts to, drop rates, that's going to fuel growth in the market. So probably we'll see some volatility in the first half, followed by, acceleration in the second half. Now, in terms of India, really great to see the market all-time high. But the market tends to be heavily overbought at the moment. So we may see a bit of a pullback to the 10-day moving average, which is 2% to the downside. But overall, we continue to be very constructive on the Indian market.
Right. What in India do you particularly like? I remember the last time you did say, names like IndusInd Bank, you liked a couple of these financials, Equitas, SFB, and you were positive on a couple of these IT names as well, Persistent and Sonata in particular. What have your thoughts been now in the Indian markets, and is there anything particular that stands out for you?
Yeah, I think financials continues to be attractive. Certainly HDFC Bank is setting up. It's not quite ready yet through our lens or our methodology, but certainly ICICI, IndusInd Bank, Federal Bank, State Bank of India, those are some of the larger caps that are actionable. Then you have the smaller financial players like Muthoot Finance, Cholamandalam, companies like that, that's setting up quite well. On the IT side, I am noticing that Tata Consultancy, as well as Infosys, they broke out into pivots, and so they are actionable. So they look pretty good. Some of the smaller names, Persistent Systems, I would say it's a bit extended now. I would continue to hold it. Nothing wrong with the stock. But if the stock starts to correct and falls below the 50-day moving average, that would be your cue to start trimming. But there are other smaller IT companies like Coforge or Cyan that looks attractive at the moment.
Okay. Dean, hi, welcome to the show. Just wanted your thoughts in terms of what's taking place in the Red Sea with the Houthi militants, and what's taking place in terms of the cargo diversion from the shipping end and the impact on crude prices, because overnight we've seen a little bit of an inch up when it comes to Brent crude to around $79 per barrel. But anything to be cautious about, say, in the next couple of weeks when it comes to such kind of a risk?
Yeah, I mean, right now, the street crude, I think it's around 72. Next support is at 70, and resistance is at about 73. So I believe the 200-day moving average is around 75. So anything above 75, we should start to get cautious. But there's heavy resistance around that level. So I would say first stop or first resistance is at 73. Should we breach that level, we should keep an eye on it. But right now the oil is sort of going sideways. The oil price cannot actually accelerate from here. So we're looking at 73 as a critical level. That's a 21-day moving average.
All right, we leave it at that. Thanks a lot for joining in. Appreciate your thoughts. So India continues to be one of the preferred markets for Dean Kim, for William O'Neill rather. They believe there are more upsides in store. Let's step into a quick break. The Gift Nifty suggests today is going to be a very strong day. So let's take it straight to individual stocks when we come back. Our entire research team will be with us. Stay tuned.
CNBC-TV18, embarking on a quarter-century of excellence. Muthoot Microfinance century of excellence.
Okay, let's begin the day by taking it straight to individual stocks that you need to watch out for. Rima joins in first up to tell us why IT stocks should be on your radar. Rima, how did the Accenture numbers look?
Well, Accenture reported their Q1 FY24 numbers and they were largely in line. No big positive surprises, no big negative surprises. The company's Q1 revenue growth has come in at 1% on a year-on-year basis, in line with the company's guidance. Now, what's relevant for Indian IT? One, the outsourcing pace for Accenture, which has gone up by 6.4% year-on-year, and deal wins have picked up by 21%. But what's also fairly heartening is consulting. Now, while Indian IT does not have direct exposure to consulting, consulting demand is a indirect indicator of discretionary spend. And consulting was contracting for Accenture for 3 consecutive quarters, given the tight economy. And this quarter, consulting revenues for Accenture have been flat. Though the management does say that generally discretionary demand and spending is going to be fairly muted in FY24, but we'll watch out for, is this a bit of a silver lining, what consulting has reported. Full year revenue forecast has been maintained at 2 to 5%. Though remember, it's the inorganic component of this is going to be fairly large at more than 2%. Another interesting point to note is generative AI this time has contributed 2.7% of its overall revenues at $450 million of sales. So this is clearly soon, very fast becoming a growth driver for IT companies. And we'll watch for more clarity when Indian IT companies report their numbers. Back to you.
Okay, all right, Reema, thanks very much for that. So that is the Nifty IT index, which was lower in yesterday's trading session. But Mangalam, a lot of action in the FMCG space. Varun Beverages.
A lot of action. In fact, Ravikant Jaipuria, who's the promoter of both Devyani and Varun Beverages, isn't on an acquisition spree. Yesterday was Thailand and today is South Africa. I wonder what his flight miles would look like, But, as far as the news is concerned, Varun Beverages has gone ahead and acquired the beverage company in South Africa for around 1,320 odd crores. Beverage company has basically the franchise rights for Pepsi in South Africa, Lesotho and Eswatini. Also has the distribution rights for Namibia and Botswana. What does this acquired company have in terms of revenue? Close to around 1,600 odd crores. So to the overall volumes of Varun Beverages, this acquisition adds 15%, adds about 12% to their revenue and 7 to 8% of the EBITDA. Why is it that with 15% volumes, the EBITDA and revenue addition is lower? Because 85% of the volumes generated by the beverage company are generated by their own brands and not Pepsi's brands. And that's where the positive triggers for Varun Beverages comes in. One of them is that South Africa's per capita consumption of carbonated soft drinks is 240 bottles per year, much lower than India. So that's a big growth propensity there. And in this market, Pepsi has low single-digit market share. Varun Beverages can grow that. Higher shares of volume coming in from Pepsi could aid their business even further. And finally, 15% of their volumes are generated by their own energy drink brand called Reboost. That's a big opportunity for Sting. In India, Sting has been their fastest growing product in the last 3 years. If they can replicate that in South Africa, it'd be a big positive. Okay, well, I was reading a report from one of the publications which said that household penetration of cold beverages in India has risen from 38% in 2019 and now almost at 50%. Yep. That's a big rise in household penetration of cold beverages. So I guess Varun Beverages is one of the big companies to benefit from that. But Nimesh is joining in. He's tracking Nippon India AMC and the Embassy REIT. Nimesh, over to you.
Hi, Sona. There's a mad rush going on for promoters and Ps to exit thanks to the domestic liquidity. The biggest block today would be Embassy REIT's 23.5% stake is getting sold by Blackstone, and they're going to raise more than $800 million by today's block deal. The indicative price is around 310, which suggests a 7% discount to yesterday's closing price. So expect a downtick on Embassy REITs to start with because there is a large block and at a discount as well. The second name is Nippon India AMC. It was part of my chatter list as well a few days back. Strategic investor, which is IndusInd Bank, they're going to sell their entire 2.8% stake. So it's a clean-out trade in Nippon AMC. Most likely, the deal might happen in the block window. In that case, you might see a bit of a green take on Nippon, but a large block is on Embassy REITs today.
Okay, all right, Nimesh. Thanks very much for that. So a lot of fund action, and we're not over yet. JK Tyre and UPL. Yes, in fact, JK Tyres has launched a 500 crore QIP, and the stock is in focus. I'm going with green over there. It's set 358.9 as the floor price. But the important bit is this, JK Tyres is now looking to expand its tyre manufacturing capacity, and that's because demand has picked up in a big way. They are looking to make an investment of 1,025 crores to expand their capacity, and they're looking to fund it via either the equity or internal accruals or through debt. So they're looking at various funding options. But the important point is this,
The stock has doubled in the last 6 months. 6 months ago, the stock was 188. Today, it's almost 400. So the street has perhaps priced in a lot of the demand up move as well, and the fact that crude prices have fallen. But yes, expanding their tyre manufacturing capacity is the positive, so I'm going with green. UPL is also going to have a board meeting on the 22nd of December. They're going to be considering fundraising as well. So that's another stock that we're looking at this morning. But Sudarshan is joining in. He has Astral on his plate today. Sudarshan, why are you looking at that?
Morning, Sonia. So one more company is joining the list of promoters using this bull run as an opportunity to raise fund or say dilute some stake. And I'm talking about pipe manufacturing company that is Astral Limited. We understand from sources that promoter of the company is likely to dilute 2% stake to raise a little more than rupees 1,000 crore. As per the term sheet we have an access to, it indicates that floor price for the deal is seen at a 1% discount to current market price. And now if we talk about the shareholding, promoter of the company currently holds nearly 56% stake in the company, and it's been around the same level for the last 4 years. Last time promoter had sold any stake in the company was in September 2019. That time they had sold 2.4% stake at a price of rupees 962.48 per share. Since then, stock price has doubled and it's currently trading at rupees 1900 per share. In 2023, stock is up 30% so far.
All right, Sudarshan, thanks a lot for that. So that's about Astral promoters taking the advantage of a bull run. With that, let's move on to the NBFC space. Abhishek joins in with the latest on that one. Abhishek.
Well, some NBFCs could be under pressure today. RBI has come out and said that transaction of regulated entities, that is REs involving AIF, that is alternate investment funds, have raised regulatory concerns. So they have noticed transactions wherein, intending substitution of direct loan exposure to borrowers with indirect exposure via AIFs is actually seen. So regulated entities cannot invest in AIF or scheme where downstream investment is directly or indirectly in a debtor company. REs have 30 days to liquidate investment in any AIF that they have, and scheme, which makes downstream investment in a debtor company. Inability to, liquidate your AIF investment will lead to 100% provisions for these NBFCs or banks who have exposure to AIF. So if AIF have first charge over defaulting companies' assets, REs lending to these companies should provide additional capital against the loans. So RBI's new rules on AIF actually covers all aspects of lending institutions, banks, cooperative banks, NBFCs, etc. Jefferies has written a note. They say that the exposure to AIF of stocks under their coverage, Piramal Enterprise has 16% of net worth or about 7% of AUM, and IFL has about 11% of net worth or about 2% of AUM. So if REs have to make these provisions, the impact on net worth would be around 10% for Piramal Enterprise and about 8% for IFL. Back to you.
Okay, all right, Abhishek. Thanks very much for that. Well, let's now hop across to Vivek. He's looking at BPCL and Petnet LNG.
Well, good morning. The first stock that we're speaking about is BPCL. Some capex coming in from BPCL this time around. The company is looking to set up a polypropylene unit. This is at Kochi. The total cost of this particular project is over 5,040 crore, and the proposed capacity addition is 400 kilotons per annum of polypropylene. Now, the second stock on our radar, Petronet LNG. So now a subsidiary of Deepak Nitrite has gone ahead and approved execution of a binding term sheet with Petronet LNG. This particular approval is for the offtake of 200 kilotons per annum of polypropylene as well as 11 kilotons per annum of hydrogen. So this particular offtake will be from the Dahej plant of Petronet LNG. So positive for both of these stocks.
All right, thanks a lot for that. Here's a quick recap of our top 10 stocks. Stocks with positive news flow: IT stocks, Varun Beverages, Nippon India AMC, JK Tyres, UPL, Astral, BPCL and Petnet LNG. While stocks with negative news flow, there's Embassy Office Parks REIT and NBFCs. But there are also a lot of brokerages that have come through this morning, interesting ones at that. So let's get straight to it. Sudarshan is here to tell us what to focus on for the day. Sudarshan, over to you.
In the brokerage corner today, we have three stocks. First one is CLSA and Ashok Leyland. It has buy rating with a target of rupees 238 per share. It says commercial vehicle upcycle to continue as indicated by strong freight rates. CLSA is building in 6%, 10% year-on-year growth in heavy truck volumes for Ashok Leyland for the next 2 years. Next one is MS on Manappuram Finance. It has an overweight call with a target of rupees 210 per share. It says it likes companies intend to protect 20% return on equity with 20% sustainable loan growth. And in the gold loans, companies targeting 8% growth with 21 to 22% yield. Last one is Macquarie on delivery. It has an outperform call with a target of rupees 520 per share. It says companies poised for better growth in H2 FY24 and company maintains its view of 15% plus gross merchandise value growth for overall e-commerce segment.
Okay, all right, Sudarshan, thanks very much for that. So that's a clutch of brokerage calls to watch out for this morning. But let's go across to Manisha Gupta, commodities editor. She joins in for a roundup of all the action from the commodity market overnight. Manisha, morning.
Morning, and thank you for that. Well, I'll talk about the crude oil prices first because we just about are inches away from that $80 per barrel mark yet again for the Brent prices. Almost did that in the New York session yesterday, and today is the third straight day of gains coming in for the crude oil prices. We are trading at a 2-week highs right now. Well, what's happening in Red Sea on commercial tankers in sense of Houthi attacks via missiles and drones is something that has been keeping the prices higher. And then there is output concerns also coming in from Russia, and the OPEC output cut is what the street is now looking at. The U.S. inventories in the meanwhile is something that the street will watch out for, and the further direction would come in from that. But it clearly is the metal space that seems to be buzzing. This is going to be a second straight week of strong gains coming in for this. Are concerns of mine closures, disruptions, not just in Canada, but also in Peru and Chile, and that has been keeping many of these metals in good favor. So copper is trading at a 19-week highs, aluminum at a 2-week highs, and if you look at the money managers, the new marginally not net long positions is what we are seeing in case of copper, aluminum, even steel. So these three metals clearly seem to be doing better.
All right, Manisha, thanks a lot for that. So that's about the commodities arena this morning. Let's take a short break, come back. On the other side, we have Prakash Diwan joining in with some fundamental stock analysis. Also, we'll be joined by Pankaj Poddar, who's the Group CEO at Cosmo First, to discuss their business outlook.
CNBC-TV18, embarking on a quarter-century of excellence. Muthoot Microfin Limited on a quarter-century of excellence.
Welcome back. Well, it is a green screen when it comes to Asia, and the implied open for the Nifty is also a little bit in the green as we speak, so that should come up for you, or just about flat, or rather higher at this point. So let's see whether we manage to sustain those gains or not, and what takes place with the mid-cap index, which ended lower in yesterday's trading session. We have market expert Prakash Diwan joining in now to discuss a couple of stocks. Prakash, hi, welcome to the show. Well, let's kick it off with the IT space. Accenture, numbers overnight, guidance maintained. What do you think that'll do for the Nifty IT index this morning?
Good morning, Ekta. So yes, you're right. The Accenture numbers kind of bring in some sort of a hope that there is probably revival that's imminent, or at least the companies anticipate that, given the action on recruitment. It's been fairly long that they've added strength. Bench strength. And the second thing that was interesting in the Accenture numbers was the contribution from AI, which is right now just about under 3% take up, but it tells you that there's enough headroom for growth in that space. Now, if companies were to kind of start looking at building on this particular area of work, there's enough opportunity to precipitate a turnaround. So I think the market is going to read this positively. And the fact that they've maintained the targets for year-end, FY24, which of course for them is another 6 months into the next financial year, is very positive. That if you were to buy any tech stocks today in India, you are at least looking at some sort of a clear emergence of a trend beyond the bottoming out phase. So if banks have run up so much and you probably find them pricey, if the PSU stocks are a bit too high in terms of valuation, IT probably provides that sucker to kind of move into at reasonable valuation and look for some sort of a tactical up move. So I think the IT index will definitely see a lot of action today and beyond. And we've already seen a little bit of a revival in the last few trading sessions. That could probably actually gain some more momentum after these numbers.
So, I just wanted, Prakash, hi, good morning. Just take that generative AI, the talk forward, right? I mean, it's like AI this, AI that. Everyone's talking only about this. So 3 companies which have moved forward in this space recently. Yesterday, Happiest Mind told us that they've set up a business unit focused specifically for generative AI. Cyan told us that they've teamed up with Microsoft to drive innovation in this space. And then there's, of course, Tata Elxsi that has Edge AI, which is perhaps, first mover advantage in this space. So from these companies, they've already rallied quite a bit. Anything that you would still buy?
So, good morning, Sonia. So you're right. You would need to look at companies from an absolute renewed perspective, given the fact that some of them are going beyond their, traditional business streams or revenue streams of ENRD and, the other regular services around digitization. Now, if AI is something which Indian companies can start building on, like Cyan, for example. I mean, they've got the right kind of experience, the kind of client relationship which will be willing to trust them with some sort of solutions, in this space. I think you will probably see an altogether new growth trajectory. So out of all these companies, if you ask me, Cyan has been the one that, of course, it's run up quite a bit. We've spoken about this at levels which are very mouth-watering. And maybe the risk reward today looks, it's almost 3x in the last couple of years. But you will probably see a new growth engine coming to some of these companies if they can continue building on. So there's no harm in doing that. I mean, remember, Tata Elxsi was at one time below 1,000 rupees and where it is today. So companies can go into a very different growth orbit if you discover and, start leveraging on a new area. And I think the AI space is something which is open for all, but very few will be able to actually go further and build at a rapid scale. So that's the advantage you need to take. So I definitely, out of these names, Cyan is still a very good buy for us. As I keep on saying, don't look at the price historically, look at the price on a futuristic basis. Say today, what is the price and what is it that it could go to? And that definitely seems to be carrying the potential to outperform the larger, indices or the broader markets.
All right, Prakash, I remember you liking delivery earlier from all the new age companies. This morning, there is a note that is coming from Macquarie. They have a outperformed rating with a target price of 520 odd rupees. And I remember earlier in the month, I had a conversation with the management as well. 15% growth in their e-commerce GMV. They're looking at capex as a proportion of revenues coming down, margins expanding. Do you think this is poised for an up move?
Well, good morning, Mangalam. Absolutely. See, look at where it's standing. It has absorbed all the damage that actually started. The business started actually on a decline in terms of growth parameters somewhere around last year. It's exactly a year back when this whole alert on e-commerce came in saying it's not picking up as it was expected, and they still continue to expand. And their expansion was actually something which impacted the P&L in a significant way because they didn't take it on the balance sheet as much, right? And you also have overhang of some of the larger PE exits, which through the year you've seen, it's kept a lid on sorts in terms of whatever the stock could react to positively. But today, where it is, the capacities that it has, the kind of acceptance of applications that they would have in terms of newer sectors, newer client relationships, all of that is going to start helping them. And the difference between delivery and the other players, the number 2, number 3 players in the space is widened. So while the environment has been tough for everybody, some of these stronger players actually will emerge stronger once things look up. And I'm a firm believer that ONDC in India is going to be probably what UPI did, a few years back in terms of reinventing the entire value chain. And some of these companies stand tremendously to benefit from that. So wait for consumer demand to go up and e-commerce to get much more mature. And definitely delivery will probably start delivering.
All right, and perhaps wait for some of the supply to come in as well and get absorbed too. We had reports that SoftBank is looking to sell stake on Delivery. So that's about Delivery. But let's welcome our first corporate interaction on the show today. We have Cosmo first. It's been a bit of an underperformer this year, largely because of global factors in the packaging industry. Pankaj Poddar, Group CEO, joins in now to discuss their business outlook going forward and if the worst is over or not. Pankaj, thank you for joining in. Always a pleasure speaking with you. The question, of course, is how has demand been, especially in Europe? And what's your current split between specialty, non-specialty? Is the worst behind you?
Yeah, hi, good morning. Let me segregate the business into two parts. One is our age-old business of films, which again, I'll break it down into BOPP and polyester later on, and then new age businesses that we have started in the recent years. So first talking about films, BOPP, if we see, it's fairly balanced in demand and supply. However, the unfortunate part is that better sense is still to prevail in the domestic market. Companies are not realizing that, if they're adding capacities, they have to take the role what China did in the earlier years of doing more exports. I feel the overall export market for us has been getting better. It's obviously not near the normals. However, this recent tragedy of shipping is obviously causing some nerve breakdowns in last 2-3 days. But irrespective, I generally feel that the export market is getting better. And in next few quarters, it should stabilize, barring US, which is still a question mark whether it will have a soft landing or a hard landing.
Actually, interesting, Pankaj, you brought up this whole shipping issue, right, at the Red Sea. You said it's causing some nervous energy everywhere. For Cosmo first, for your industry particularly, what do you think the impact would be?
To be honest, the 16 containers that were there on this particular ship, our containers were also there on this. However, what has been confirmed is there is no damage to this, and obviously these are fully insured. So financially, there should not be any impact. In the short term, there could be some positive impact because consumers will tend to buy more. However, in the in things which are in the transit, customers are a bit worried in terms of, in the normal course, it was taking 30 days. It may take 45 days because of the new routes. So next 1 month, we'll have to stay very, very close in terms of how this is folding up. Customers are fully aware, and we take necessary actions so that customers keep getting their material.
Okay, so as of now, you don't see a risk in terms of financials. The next 1 month is when you're probably going to assess the risks with regards to what's happening in the shipping environment.
I feel as I said earlier, in the short term, there should be a positive impact because of this, which is temporary again in nature, because customers will end up buying more. They will stock up more because the lead times have gone up. This is very similar to COVID, where again our exports really went up, and same situation is emerging now, where exports will go up because customers are aware of this fact that transit times have gone up. So in the short term, this is my personal belief that this will have more positive impact than the negative impact. But in the medium term, it will neutralize, and again, for some period, the demand will get back to normal, or go a little down and then get back to normal. The other thing in the the other thing that I would like to talk about in the films is that we had put up the polyester line last year, and obviously since the time we have put it up, there's too much of extra capacity which has come up in BOPET. And actually our line was supposed to be more for specialty, and we were struggling with our shrink film. December is the first month when the supplier got rid of all the issues, and the machine is working very well. We had a very good long run in December. And specialty, which has right now touched only 5% in our portfolio, we feel that even in the BOPET, we will be able to take it up to 15% overall specialty. And this particular line, which has been making losses since the time we have installed it, should now start making, should start doing break even on an immediate basis. And in the months or quarters to come, it should start making money as well.
And in the films business, if I just wanted to, recollect, what is your specialty mix right now? Earlier, it used to be 64, 65. It had dropped to 57 in the middle. What does it stand at right now?
So it has gone back to 65%. Obviously, as I said, some of the markets are not really up to the mark. But the good thing is that last 3-4 months, specialty has really picked up. So it went down to 57. And the traction in most of the segments is much better now, barring one segment where we are yet to see the revival of the growth. And customers continuously been telling that 2024 should be a much better year. And hopefully then we'll be able to take it to 68 to 70% in next 1 or 2 quarters.
So do we see better margins for your business? Because I remember at peak, it was around 18 to 20 odd percent. Last few quarters, it's been sub 10% as well. What kind of margins do we expect in FY24, and what does your FY25 picture look like in terms of revenues and margins?
So see, when the whole industry is making losses and Cosmo is able to make close to double-digit EBITDA, that itself, I personally feel that we have done a good job in the last few years. Because 7-8 years back, we were in the same boat. When the industry was making losses, we were making losses. So one side, yes, our EBITDA margins have come down. And as I said, the domestic market continues to reel under pressure. And to be honest, BOPP should not be under as much pressure as it is. And maybe 1 or 2 players are, continuously keeping prices lower to sell their volumes, which to me is not a very good strategy. So it's very difficult to say when the domestic margins will pick up again. In fact, they have gone down in last 1 quarter. And to me, this is insane, and it should get better in the times to come. But for the time being, I would not say that results would improve because the domestic margins continue to struggle. What we are really improving is our specialty, taking it back to 65% levels. And the quarters, we feel it should go to 68 to 70%.
So overall, you're saying domestic margins will continue to struggle. I mean, you're barely now at double digit, right? Almost, I think 11%. You think there is a possibility of getting into single digit margins as well?
See, 1 or 2% here and there can always be possible for the simple reason that, as I said earlier, that one side our export margins have gone up while the domestic margins have come down. So we have to really see this quarter, and normally quarter 3 is the weakest amongst all the 4 quarters because of Christmas and Diwali, where post Diwali and immediately for the Christmas time, the demand comes down for us. So we have to really see this quarter, but as I said, it should be around 10%, and better sense should prevail. Domestic margins must go up because BOPP demand supply is quite balanced. And the good news is that even in the polyester line where we were making losses, we should start touching break even now, and in the quarters to come, irrespective of the bad market, we will start making some money on our polyester line.
Okay, just quickly, Pankaj, before we wrap this up, your pet care business, there was a huge surge in terms of pet care post-COVID, but is that sustaining? What's the outlook in terms of, say, the monthly run rate for the business? Are you looking at further fundraising simply because of the opportunity available?
Yeah, so pet care definitely during COVID period had an abnormal growth because people had a lot of ample time. That has normalized now back to 10 to 15% in my view. Again, looking, what I would say the experts say in this industry is that in next 3-4 years, this industry will have a very, very fast growth for the simple reason that the average family size in India, at least in bigger cities, will come to a certain threshold level from where the pet care, where people will start to adopt more pets. So that period is yet to come when this industry will again have 20, 25, 30% growth, which will take 3-4 years. Irrespective, the growth itself is quite nice of 10 to 15%. And, we have now reached a monthly GMV of 3.5 crores. So if you really track our numbers quarter on quarter, we are growing by 50-60 lakhs per month of GMV. And, what we are really doing in pet care, see, our grooming has done exceedingly well. Our online sales is continuously picking up, and so is our, overall product sale. What we are now focusing a lot more because we are a digital ecosystem, omni-channel ecosystem. So what we're really now focusing is to bring many more senior vets into our fold. That is one of the focus areas so that we can develop, and vets is really the center stage of this industry. So we intend to bring more senior vets, strengthen our vet practice. Now is the time for us to bring house brands where the gross margin should be better. And then we also intend to launch a very strong membership plan, especially on the services for our customers so that, they can tie in and they can continue to enjoy our services and products that we offer.
So this 125 crore revenue target that you had for next year in pet care holds, right?
No, we never said for the next year, but I feel that we should be, next year should be close to, 75 will be on a conservative basis, on an aggressive basis will be close to 100 crores. Till now, we are tracking as per the numbers that we had given to the market.
Okay, all right, Pankaj, we're going to let you go on that note. Thanks very much for joining in and speaking with us. So that is Cosmo talking about their business. We need to take a short break, but up next, Mitesh Thakkar and Prakash Gaba will join in for some technical trades pre-open. Stay tuned.
CNBC-TV18, embarking on a quarter-century of excellence. Muthoot Micro, embarking on a quarter-century of excellence.
Welcome back. Well, we have technical analysts Mitesh Thakkar and Prakash Gaba joining in for some pre-market calls. Mitesh as well as Prakash, welcome to the show. Morning. Well, Mitesh, let's start with you. The Nifty has not made big moves in the past 2 trading sessions. What would your call be today?
Good morning. So, we've advocated to be basically looking at declines to buy into. I think the indicators on the Nifty and the Bank Nifty on the intraday charts are slightly overbought. So a couple of days of pullback is quite possible. In fact, today we might open with a gap up. And then if we see any kind of supply pressure emerging, we might want to prune our long positions, wait for some kind of an intraday dip to re-enter. So I think the overall trend is on the upside, but only because of the fact that the last couple of weeks have produced very strong movement on the upside. I think there could be a chance of a mild pullback or a couple of days of consolidation, but I would be a buyer on declines.
A buyer on declines, all right. Prakash, your thoughts? Where do you think the market's headed?
Well, good morning to you. So far, looks like the market is up, clear cut. 21,350 is a very, very strong support zone to work with. As long as we are above it, I think we are fine. Only if we open with a gap up, we could stay there or maybe a dip possible. But if it dips, opens the gap down, I think those are buying opportunities. Or even if it opens flat on Nifty, I think it's a buying opportunity. So what I would look to dips or a flat opening for a buy. Simple. Nifty is looking good to me as yet.
Nifty is looking good to you. Prakash, let's talk about individual stocks then. Where do you see maximum traction coming in from? Do you see it come through from banks, PSUs? PSUs have started to, some profit taking is visible in some of the names. But your thoughts?
Well, I would look at, yes, PSU profit booking may be possible, but purely because there's a fatigue. It is not weak, maybe because of profit booking, not charts. I would look at Havells India, certainly looking good to me. The structure is beautiful, has seen some kind of a consolidation, and a breakout has happened yesterday. Trading at 1372 Havells India. Have a stop below 1360. If it opens flat or dip, possible buy. Targets are in the vicinity of 1400 zone. So I would look at Havells one. Second stock that I like is Cipla. Cipla has seen a good base formation and seen a good breakout here, trading at 1236. I would have a stop below 1225 or so, trade long. Does it go to 1275? Yes, I think it's going to 1275. The third stock that I like is Bharat Forge. Slow mover, low beta, but looks like it's good. 1220 is trading at 1220 zones. I would have a stop below 1213. Yes, 1213. And possibly we'll see a move up to 1250 zones. So yes, Bharat Forge also is looking good to me.
Okay, well, Mitesh, what are your picks?
So I have a couple of names matching with Prakash. Cipla is on my buy list as well. Recommended stop at 1218. Look for targets of 1275. Havells is a buy with a stop below 1350 for a target of around 1415 on the upside. That apart, TCS is something which I think has given a good pullback for the last couple of days. So buy here with a stop at 3790 for targets of 3890. And Marico is the final call, which I recommend buying with a stop at 540 for a short-term trading target of 560.
All right, thanks a lot for that. Let's do one thing. Let's take a quick break. On the other side, we'll have the pre-opening rates. Rajesh Palvia of Axis Securities will be joining in with some F&O strategies. Stay tuned.
CNBC-TV18, embarking on a quarter-century of excellence.
Go powered by Century.
CNBC-TV18, embarking on a quarter-century of excellence.
Welcome back. We have some of the pre-open rates coming in. not prudent to look at the Nifty and the Sensex, which is all over the place. The Nifty is indicating a 155-point bump up. We'll wait for that to settle. But a couple of stocks, interesting moves out there. We're seeing a decent move come by on ICICI Bank, up around 3% Container Corp is up around 4% as well, and TVS Motors doing well too. On the obverse side, we have India Bulls Housing Finance, which has been doing well for the last couple of trading sessions, so likely to open mildly in the red. And Oil India is the one that stands out in terms of an up move. Rajesh Palvia, who's the VP Technical and Derivative Research at Axis Securities, joins in now. Rajesh, what are your thoughts on the index, Nifty Bank in particular, and individual stocks that you liked?
Good morning, Mangalam. So overall structure for both indices are in the bullish trajectory only. Even in the previous session also, we have witnessed that long built up was there. Put writers are aggressive. They are shifting their position on the higher side. So that clearly indicate that put base is clearly give us the confidence that market may continue further more bullishness from the here onwards. For Nifty, the immediate hurdle based on the data setup, that is around 21,550 to 21,600 are the major supply zone as of now, looking at the call concentration. And on the downside, 21,400, 300 are the important support area on the downside. For Bank Nifty, overall structure is bullish. 47,700 is the key level to watch for today's trading session. If we hold those levels, then possibly we may see an attempt of again, crossing 48,000 level. That is the immediate hurdle at this moment. If we crosses those level on Bank Nifty spot at 48,000, then possibly we may witness some more short covering action towards 48,300 to 400 kind of zone. So play this weekly expiry option expiry for Nifty. We are initiating here short straddle strategy of at the money for 21,450 call put. We are initiating here short straddle. So by writing this combined premium of 21,450, we are pocketing around 147 rupees as an inflow of premium. As we are projecting that Nifty may consolidate in range of 21,300 to 21,600. So this strategy may give you some profit towards this weekly option expiry. Once this premium shrinks to around 80 or 70 odd level, one can book profits. Keep your stop loss at around 180 to write this premium of 21,450. On stocks front, we expect that Voltas may continue furthermore upside. As in the previous session, there was a clear long build-up is there, and already stock is formed a bottom, and now it's taking a shape of a rounding bottom formation on a daily chart. So we expect that Voltas may continue furthermore upside towards 925 to 930. So one can buy this stock with stop loss of 885. The second stock that we like is HDFC AMC. After a brief consolidation, now stock managed to give breakout of almost 7-8 days consolidation. Long built-up is there. So looking at the overall structure for HDFC AMC, we expect this rally may extend towards 3,200 to 3,240. One can buy this stock with stop loss of 3,085. And the third stock is Colgate-Palmolive. This stock is also looking promising. Most of the FMCG stocks have witnessed short covering action in previous session. We believe that FMCG pack can do well in today's session. So Colpal is buy for upside target of 2,500 to 2,520. Keep stop loss of 2,378.
Okay, all right, Rajesh, thanks very much for joining in and giving us all of those F&O calls. Let's get in a couple of stocks before markets open. And I think one of the big stocks of the day would definitely be Varun Beverages, Mangalam. Doubling down on Africa is what Kotak has titled their report as.
Yes, doubling down on Africa and perhaps, getting a lot more revenue from Pepsi, etc. as well. I'm just looking at the brokerage notes after the news that came in yesterday that they will buy, the South African bottler for around 1,320 odd crore rupees. CLSA has upgraded the stock to buy and effected a near 40% rise in their target price from 1,070 to 1,400 odd rupees. They're saying that this is the continuation of their inorganic strategy, which the company has been doing. And it's been done at a very attractive valuation as at 0.83 FY23 EV to sales, much lower than the company's own valuation itself. Jefferies has said that this again is on expected lines given the company's past communication, but this deal fast tracks their plan because this is a ready capacity network and they expect excessive focus on PepsiCo brands, which account for just about 15% of this acquired entities volumes, which will also be margin accretive. So let's reiterate there's those triggers. One, South Africa's per capita consumption of 240 bottles per year is good. Pepsi's single-digit market share gives you headroom for growth out there. Higher share of volumes coming in from Pepsi would be margin accretive, as Jeffries has pointed out. And 15% of their revenues are generated by energy drink Reboost, which means that Sting would get a foot in the door in South Africa as well.
Okay, just look at that move in pre-opening, 20% higher now. And let's not forget, this is a stock that has been a huge wealth creator for investors. I mean, if you map a 2-year or let's take a 5-year call, right, on Varun Beverages. 5 years back, it was at 100 rupees, 111 rupees to be precise. And look at where it's at today. The kind of wealth that some of these consumption companies have created for investors is phenomenal. And now on the back of that big run-up, there's another 20% up move expected. Prakash Diwan is still waiting by with us. Prakash, any thoughts here? We talk about how stocks are expensive, but who is to say that after 50% rally, they can't rally another, they can't double from there, right? I mean, we've seen it happen with so many stocks in the past. Are you still bullish on Varun Beverages despite the rally?
Sonia, so after today's 20% move, it seems imminent once you open. It will price in quite a few of these salient points that even Mangalam has very rightfully brought out. This is a great acquisition for them. They get presence in a market which they don't actually have much of a play right now. But when you mentioned this 111 to 1400 journey, remember these are businesses that are unique in the listed space. So it's very difficult to kind of put value when they initially come into the reckoning. But now that people have understood the kind of growth that comes along with this presence, it's easier to attribute much more serious valuations and extended valuations to it. But I believe it's kind of priced in quite well. You would need to kind of look at buying these kind of companies only on some sort of a news flow which is negative, but may not be very permanent. So that's the way to play most of the consumption names. Buying them at expensive levels could probably make you wait longer for some sort of an alpha creation in the future.
I would tend to agree with you, Prakash, out there. At 1350, the stock would trade at around 65 times 1 year forward earnings. And even at current levels, with the up move that we've had, nearly 17, 18 times since the IPO, the stock has moved into the top 50 companies by market capitalization band. So just for perspective, Varun Beverages in the FMCG space is higher than in terms of market cap, Pidilite, Marico, Britannia as well. Wow. And the non-consumer companies, the market cap of Varun Beverages is now higher than names like Dr. Reddy's Ekta and Siemens and a lot of these other companies too. So yes, there are growth prospects, but just keep an eye out on that market cap, 1.5 lakh crores.
Okay, well, Prakash, just a quick question before we get to market open. The RBI tightening norms for lenders' investment in AIF units. A lot of these NBFCs could be in focus on account of that. Have you done some work on it? What are the stocks that would be in focus? And do you expect significant downside today?
So it's a continuation of RBI's efforts to tighten the belt in terms of wherever they felt there were potentially areas which could kind of enhance the systemic risk. They're trying to kind of curb that, which is so important, right? And the next phase of growth is going to be very favorable for NBFCs who on a standalone basis can raise money. So go back to the big names again. Though it's expensive, Bajaj Finance continues to hold sway. You'll have probably the Cholas and the Sundrams and the Srirams of the world, which do not get impacted by these kind of funding arrangements. So I think it's a good move for the sector, but possibly for some of the weaker names which were thriving on easy money coming through these structured deals, that could probably be a little bit of a growth issue, and they'd probably not be able to match the growth of the leaders in the sector. But if you stick around with the leaders, I don't see any issue with the NBFC space, because that's definitely likely to kind of reward. In fact, some of the smaller names also which have built a franchise where they can raise money on their own strengths will do well. And one of the names that I like in this is 5-Star Business Finance. It's a very small company, gets into small ticket, but the kind of structure that it has in terms of its credit, appraisal systems and deployment and collection, it's remarkable. So I would be a bit picky about this, but I don't think the big ones will get impacted today.
Okay, well, Prakash, just stay on. We have to get some 9-10 calls going. But before that, just wanted to, tell our viewers it's going to be a really good day of trade. So a couple of things, of course, to keep in mind. December end, the last 2 weeks usually sees FII in action. because, the foreign investors go on leave. So you don't have to necessarily take this move very seriously. The big trend move will come in Jan first week onwards. And there are some issues on the horizon, of course, like this COVID-19 flare-up that has happened in certain places. There's a Red Sea issue as well. Just keep a little bit of this on your radar. Otherwise, this bull rally is something that continues. And generally, the last leg of this bull rally is fast and furious. I'm not saying that this is the last leg, but generally, that's what happens. But Mitesh is joining in. Mitesh, what's the big call at 9:10 this morning? What are you looking at?
I'll go with a buy on Havells with a stop at 1350 for targets of 1415.
Okay, that's on Havells. Abhishek is with us to give us the momentumizer stock of the day. Abhishek, over to you.
Well, IndusInd Bank is on my radar. Over the last 1 week, it's outperformed Nifty, while in last 1 month, it's actually underperformed. So take a look at the weekly change. IndusInd Bank is up 4.65% versus Nifty gain of 2.6% and Bank Nifty gain of 1.6%. However, it's largely underperformed over the last 1 month with gain of 4.8% when compared to Nifty gain of 8.7% and Bank Nifty gain of about 9.8%. Take a look at the volume data. Yesterday's volume was around 360 crore with delivery volume at around 38.15%. If you take a look at the stock price is just 10 to 12 rupees away from 52-week high. Now, we also have a story coming up. Sources say that IndusInd Bank to sell about 2.86% equity in Nippon AMC via block deal. This is a clean out trade. That is what our sources are telling us. Floor price is about 426.6 per share, which is a discount of 5% to CMP. The block deal size could be about 762 crore, which forms about 9.8% addition to the EPS of IndusInd Bank. Back to you.
Okay, all right. Abhishek, thanks very much for that. Let's go across to Nimesh now. He's tracking all of the block deal action.
Yes, Ekta. So, we were expecting 4 large blocks in today's trade. 3 are already done in the pre-open. Only Embassy's left, which I understand is going to happen around 315 or 317 rupees per share. As far as the 3 blocks which are done in today's trade, first is Nippon AMC. 2.8% equity got sold. IndusInd Bank was a seller in that block. I understand the demand was quite strong, so a mix of both domestic and FIs have bought in Nippon AMC. That's the first one. The second was Shriram Piston. I was expecting a large block in that company as well. Almost 33 lakh shares got sold in pre-open. I understand the German partner was a seller and a couple of domestic funds, including an AIF, was a buyer in Shriram Piston. So that's the second block. And the third one was Astral Poly. We indicated that the promoters are going to sell nearly 2% equity. That got sold in pre-open. Strong demand there as well. So expect all the 3 stocks to open in the green and wait for Embassy REITs. That may happen at a 5% discount to yesterday's closing price.
Okay, all right. Well, thanks a lot for that. So those are a couple of stocks. By the way, just keep an eye out on some of these other names like JK Tyres as well. That's in the green right now. You have, the 500 crore QIP that JK Tyres is launching, and they've set 358 as the floor price of the stock. As you can see, is up 0.8%. The bigger, issue here is that the bigger positive here is that JK Tyres is expanding. They're going in for a big expansion where they're spending 1,025 crores. So demand, I'm sure, is good. But Mitesh is back with us. Mitesh, any of these tyre stocks that you like? I mean, JK Tyres has had a big run up. It's doubled in the last 6 months alone. Do you see more follow up here?
Oh, I think yes, except for I think some kind of breakdown I've noticed on the charts of Balkrishna Industries. So short-term Balkrishna could be in pressure. But that apart, I think JK Tyres, MRF, I think both have had a good rally. They might give you a couple of days of kind of quiet activity or a pullback, but I think they'll make higher highs. So very positive, except for Balkrishna on the entire.
Okay, Mitesh, thanks a lot for that. Well, we're heading into what will be the last 10 days of 2023. I mean, it's really been a phenomenal year for the market, and looks like today as well, we're going to kick off with a bang. 21,500 is something that can hold. Whether we build on to it or not, time will tell, but at least the opening will be good. That's because we've had a lot of positive triggers. The US market movement was good. Crude is below $80 a barrel. The US 10-year bond yield continues to be below 4%. So a lot of positives stacked up for our markets. And of course, flows have thinned out, as is the case. There's FII in action in the last 2 weeks of the year. So, perhaps that's something that you'd want to keep an eye out on. But for now, the first tick on the index is well in the green, actually 90 points higher, building on to our gains. Very strong opening for the market. The sensex up almost 300 points. Standing tall above that 71,700 mark on the sensex. The mid-cap index is where all the action is at the moment. The mid-cap index is now up almost 300 points. And we'll get to that. Of course, Varun Beverages is really the stock of the moment. You can't take your eye off that stock. So let's just get it up on the screen. 15% higher on Varun Beverages. And this is on the back of that strong rally that we've seen in the last couple of years for the stock. So phenomenal move coming in there. But back to the frontliners. The 80-point up move is led largely by a lot of consumption stocks this morning. Tata Consumer is up about 1%. UPL, we were talking about that a while back. There's a board meeting on the 22nd of December for fundraising. So UPL is up about 1%. And then you have a lot of these technology names. Wipro is holding up with a gain of around 1%. SBI Life, Nestle India, Grasim, IndusInd Bank are a couple of other names that are trending in the green as we speak. In fact, there's hardly any stock in the red. I mean, there is no stock as we speak in the red. All Nifty 50 stocks are trending in the green right now. And a lot of the IT names are up and about. Perhaps because, Accenture, as I said earlier, there was no negative surprise in Accenture's numbers. It maintained that discretionary spending will continue to be muted and that the growth guidance will be muted at 2 to 5%. There was no change in that, because of which, the opening has been pretty solid, led by a lot of the large cap names.
Nearly 8 stocks in the green for 1 in the red, as we speak. That's the market breadth for you. 2,000 stocks doing well. The one that really stands out in terms of gains, apart from Varun Beverages that you spoke about, is Nippon Life, up around 7% odd. There was source-based information that IndusInd will sell their entire stake via a block deal. It's trying to figure out whether the deal has happened already or not in terms of volumes. The volumes have picked up. So maybe it has happened and the overhang is out now. The stock is up 8%, surging as we speak. Astral is the other one that I'm watching out for. Again, a 2% up move on that counter. The promoters are likely to sell 2% via a block deal on that counter too. And BPCL, they are setting up a polypropylene unit. OMCs have generally done well. This one holds up despite oil prices moving higher. We have seen a big move on Tech Mahindra as well. And this despite this as Mohit Joshi assumes office and CP Gurnani retires. So first day met with a near 2% uptick. So that's about some of the stocks which are standing out.
Yes, absolutely. We have in fact the mid-cap index, which is up around 0.6% after falling in yesterday's trading session. The BSE small cap index, which is up around 0.6%, and the Nifty IT index, which is up around 1.4%. So that's one of the top sectoral gainers that we're seeing this morning. Just want to point out that a couple of these NBFCs are seeing a bit of pressure. So Piramal Enterprises is down around 3.3%. This is on the back of the RBI norms with regards to AIFs. So that is seeing a bit of sluggishness, along with Indiabulls Housing Finance, which is down 2.5%. And a couple of others such as IIFL Finance should probably also come up for you. But these two probably stand out in terms of price and volume action. Piramal Enterprises and Indiabulls Housing Finance are the ones that I'm talking about.
Okay, well, let's just, take stock of the market opening, which has been terrific. I mean, look at this. We've already hit a century on the Nifty and it's not even 9:20 this morning. Ashwini Agarwal, founder and partner at Demeter Advisors, joins in now to give us his views on how things have transpired so far. Ashwini, good morning. It's been great times for our markets and, celebrations galore, right? How are you feeling about the situation at hand? Do you think we can build on to our gains as we head into an election year? And what's the best way to approach the market now?
Good morning, Sonia. Thank you for having me here. It's very interesting because, if you recall when we last spoke, I had said that, the scenarios building up, that the most improbable of the happening, which is a US soft landing, is what the market is now hoping for. And that hope has, crystallized in a significant way after the US Fed meeting last week. And of course, before that, we had the Indian state election outcome. So these two rockets, I would say, have propelled the market, over the last 2 weeks. And I think a lot of the cash that might have been sitting on the sideline has been put to work. Having said all of this, I think, now I start to worry about valuations, and I'm starting to think that, markets possibly getting a little bit overstretched. So as you say that next year is full of events, we have the general elections coming up towards the middle of the year. I think the outcome there is pretty much priced in. So I don't think anybody out there is expecting any bad news for the BJP at all. So that's almost a given. for the market. So that may not cause much excitement. But what can happen, at least in the near term, is that foreign flows might become positive again. Having said that, we also have to pay attention to the kind of very large offerings that we are starting to see, both from the IPO market as well as offers for sale from private equity investors, promoters, etc., etc. You had alluded to some fundraising in the earlier comments just prior to my coming online. So I think on balance, I would say that this is the time to start becoming a little cautious. The upside is probably not a lot from here, and there are events over the next year which might prove to be disappointing relative to expectations. So, for example, on the Fed, one is expecting 4 to 5 rate cuts next year, and if they turn out to be just 1 or 2, then what happens? BJP election outcome we spoke about. You have the US general elections to contend with next year, and what happens thereafter. So, there are a lot of uncertainties, and I think with limited upside on a broad index basis, I think time to trim is here. That's how I think about it.
Okay. Well, Ashwini, I'm glad you brought that point up. Morning. That was actually my next question. Going into next year, we do have a lot of events to watch out for domestically when it comes to the elections, the Fed rate cut trajectory, and when they could also come up by. In that context, then, considering that you're getting a little bit cautious, would it be prudent to take some profits off the table? And if so, how much would you probably deploy, keep in cash then?
Morning, Ekta. The way I think about it is that, asset allocation is one great way to manage risk. And, at this point in time, what I'm doing is gradually building up my cash position, reducing equities. And that's how at least I'm doing it. Now, for retail investors and for a lot of your viewers, that may not be an appropriate thing to do because they are not watching the markets all the time, and therefore timing the market may not be the appropriate solution for them. But overall, I would say that increasing exposure to debt, for example, would be a good thing to do. Interest rate cuts will happen. Now, whether it's 1 or 2 at the Fed or 3 or 4, we'll have to see. But interest rate cuts will happen and they will follow through in India as well. So, getting invested in duration probably is a good trade to do. Therefore, increase allocation to debt. That's one way for your viewers to manage their exposure. Personally, I am raising cash. It is sometimes stock specific where I think the upside is limited from here. It is sometimes, across the board. So doing it gradually because, I'm also not sure whether the market will go up another 1,000 points from here or it will go up another 500 points from here. Those things are very difficult to tell. Usually what we have seen in January and February that you do have some renewed vigor in foreign flows. I don't know whether it will happen this time or not, but that could be the one more leg up for the market if it were. But overall, I'm cautious and therefore raising cash, increasing exposure to debt is what I'm recommending.
All right, you are cautious, raising your cash and also increasing exposure to debt. But those who are, looking at equity markets and places of safety in the markets itself, despite the run-up that we've seen, would you have any sectors in mind, Ashwini?
More than sectors, Mangalam, what I would do is go up the market cap curve and look at recent performance. So if there are stocks that have done nothing for the last 2 or 3 years, it's likely that the relative valuation gap has narrowed. And that might be an area to park your money if you don't want to reduce your exposure to equities. So some pharmaceutical names, some downstream chemical names, some of the frontline banks, these could be the areas where you could increase exposure to, still gain exposure to the market or keep your exposure to the market, but go up the market cap curve and look at stocks that have done nothing for the last 2 or 3 years, but fundamentally well-managed companies with no debt issues, etc., etc. I mean, those caveats I would say have to go with it, and that's how I would manage it. So sectorally, I mentioned banks, I mentioned downstream chemicals, I mentioned pharmaceuticals, maybe some IT as well. Though IT trade I think is pretty much done. Maybe a little bit of IT as well as a defensive position.
Okay, a little bit of IT as a defensive position. It's interesting, you are one of the first few voices expressing caution in this market, and I think it's sane advice given the kind of rally that we've seen. And I take your point about expectation management. Now, I mean, expectations are so high that the chance of disappointment is also high. But Ashwini, there's one narrative in the market that now commodities are going to pick up in a big way. A lot of people are talking about investing in gold in a big way. Silver could be the new gold as well. There are, recommendations on raising your exposure to silver ETFs. What are your thoughts on that?
Sonia, the materials space is something that has eluded my understanding all these years that I've been investing in the markets, because there are far too many global demand supply issues, global news factors that drive it. Now, let's take gold that you mentioned, right? Typically, gold has been an asset that does well when economies globally are shrinking or doing very poorly. So on one hand, we have a narrative in India that the Indian economy is doing very well, and therefore you should be exposed to the markets, capital goods, defense, government spending plays, etc., etc. On the other hand, we are also positive about gold, which is technically a contraindicator to economic performance, right? So the market in places doesn't make sense to me. So either one is right. Either the economies are globally are slowing down or they are not. So I think that's the narrative for gold and silver. But outside of that, I'm very ill-equipped to advise on metals and on commodities like gold and silver. I think they're good store of cash, and maybe if I join it with my opening comments that look, you need to take some money out of equities, then maybe gold and silver might be a place to park it if you're not interested in debt. But that's about it.
Okay, well, just keep your eye out on Piramal Enterprises, because that stock is now at the low point of the day, down around 4.3%. Well, Ashwini, I'm going to toss this over to you. The RBI tightened norms for lenders investing in AIFs, or alternate investment funds, overnight. And you're seeing the impact on these specific stocks come in. They'll probably have to increase provisions. They'll probably have to liquidate their investments. It depends on the lock-in. But your view, and how would you read it?
So I haven't looked at this whole, overnight development in any detail, and I just have to think over it a little bit. But for NBFCs in particular, what I would say is that I think regulation is still evolving in many places. And like what we saw, literally a month or so ago, where they increased the risk weights, where RBI increased the risk weights for certain type of loans. Regulation continues to surprise, and that's a challenge that all NBFCs have to deal with. So within financials, at one end I'm positive on the banks, and the other hand, it would be the services or home loans that I'm positive about. But the whole NBFC micro lending space, that's fraught with regulatory risk in a meaningful way, and that keeps showing up from time to time. And that worries me. So I tend to kind of avoid these as much as I can.
Ashwini, since you're in such a candid and cautious mood, and rightly so, given the sort of run-up that we've seen, let's hear out your honest views on the kind of IPO rush that is on. I mean, are you tempted in any of them? Because there's a serious fear of missing out. Most of these IPOs, being subscribed 50, 60, 70, 80 times with huge grey market premiums as well. What are your thoughts? Is there anything out there that you found interesting?
So let's start with IREDA. I don't own it. I've never bought it. But, IREDA, debuted at whatever, 50-60% premium to issue price, and then pretty much doubled within the next week or so. It went from being offered at 1.1 times price to book, and now trades at close to 3.5 times price to book, if I have my numbers right. I mean, I've never seen these kind of price movements. It's befuddling, okay? The oversubscription numbers that you're seeing for IPOs, in the main board as well as the SME, they are mind-numbing. Some of the companies are good, but valuations are quite full. So, insofar as subscribing to these IPOs is concerned, and you might have an initial pop and you might want to trade it, that's fine. It's a little bit of fun and games. It's a little bit of tadka on your dal, if you will, right? But But this is really an indication of the froth, the euphoria in the market, and this is one of the reasons why I'm cautious, because when euphoria sets in, okay, that is when the beginning of the next fall starts to happen. So we don't know what will cause it. Okay, we will never know why market falls till the event is behind us. So I can't predict that at all. I can't even predict whether the market will go up another 10% before it starts to correct. That's impossible, right? But euphoria is a sign of trouble, and it always has been, and this time should be no different, is my take on this whole situation.
All right, wise words there, Ashwini, and we'll take all of it in good stead. Thank you very much for joining in, and hope you have a great Christmas and New Year's as well. We'll see you in the new year. Thanks very much for joining in.
Thank you. Thank you. Wishing your viewers the same. Thank you.
All right, let's shift focus now to BSE. BSE will be levying an additional 15% exposure margin on derivatives. Additional margin levy will be effective from the 1st of Jan on securities under market-wide position limits. To discuss this, we have Mr. Ramamurthy, who's the MD and CEO of the company of BSE, joining in. Mr. Ramamurthy, thank you very much for joining in. This additional exposure, additional margin levy, which you have now indicated will be applicable from the 1st of Jan. What's the rationale behind it? Does it tie in with what Mr. Ashwini was just telling us about this euphoria which seems to be setting into the markets, and to probably curb that a little bit?
I guess there is a misunderstanding on the circulars issued. This is not what you're understanding as any apply of any additional margins on the existing derivatives contract. Let me clarify, the margining system at this point of time, which is in existence for the derivatives market, will continue to exist.
Right. So what does this do to your business itself? Because on the one hand, the exchange, if you just take a look at the way the BSE stock has returned value to shareholders this year, 350%, and still looking strong. One of the things that stood out was the increased share of revenue coming in from derivatives, and you increasing your market share out there as well. The last known number was close to 13.5%. What are your thoughts on this segment, the new products that you're launching, and the likely revenue and market share from the derivative segment in the next couple of years?
See, derivatives market in India, 23-year-old, the new products that we are talking about, the first product, sensex derivatives, was launched around 31 weeks before. So in my opinion, to talk about a very long-term roadmap at this stage is not possible because it's still early stages. But a short-term, immediate roadmap and what is our thought process on this product and what its way ahead, we can share. If you look at it last Friday, around 1.5 million users we have still now participated into it, and around 43 crore contracts got traded. And around 350 members are into the system, and around 50 FPIs are in the system for this. We feel there is a long way to go here. More market participants are yet to come, and more FPIs will be coming in the near futures. And so if you ask about what will be the plan for this product, it is to increase the depth of participation and more and more participants coming in, particularly the institutional people like FPIs. That is very important for us. And to create sustainability of the current volumes and grow on it organically is very important. That will be the immediate goal. Revenue and volume projections we do not make because we are not measuring our success in terms of any of them. We are measuring our success in terms of how useful this product is to the market. Therefore, we are measuring it in terms of what will be the participation. That's where I said more users should come, more FPI should come, more members should come.
So if you can just help us, sir, with some kind of numbers. I'm not asking you for exact volume data, but what do you think the traction could look like? Not now, say over the next 1 to 2 years. And I also wanted to understand both on derivatives and also the traction in BankX futures. What is the kind of visibility that you see over there?
Certainly on BankX, see, it is just around 10 weeks since introduction. And I think this has been accepted very well by the market. The traction is good and very satisfactory. on the 10th week of introduction last Monday, as you would have seen, a sizable amount of contract got traded, and the total notional value traded was around 62.5 lakh crores. Notional values do not carry much sense. Having said that, that's also an indicator though. We had around 240 members on the day participating in that contract. I think this contract holds a lot of value for the investors. Investors are able to relate to it. As I always repeatedly tell, we are always introducing complementary products to the existing product profile in the derivatives market so that people are able to relate to it and use it in conjunction with the existing product. BankX is one of such products, as you are aware. So therefore, I think the future for this is very good. And we have around 1 lakh UCCs participating already into this. We expect it. And in my experience, what I have seen is, in my last jobs, for a product to pick up, it takes around a year or two. We found that was defied by sensex, and it started growing very fast. BankX is even faster than that, because now people all have their infrastructure ready with BSC. They have already taken the front end, back end software enabled. UCCs are put, KYCs are done. So I think the traction is fast, and it will go faster than even sensex is mine.
Okay. Actually, the reason we are stressing on the derivatives market, Mr. Ramamurthy, is also because, you know, the market share, as my colleague was also pointing out, has jumped to over 14% from around 1%. And all this has happened in just the last 6 to 8 months. I take your point that you've done this also because of new product launches. So I want to understand, in derivatives, what is the roadmap going ahead? Are there any more new products that you would be looking to launch to open up the market further?
It's a very good question. We should think about new products, but honestly, it is just 11 months since I have been here, and since the product launch, it has been just 31 weeks. So as I just said before, for me, the immediate roadmap would be to strengthen this product, make it sustainable, increase the participation, depth of participation, bringing in more institution and institutional members. We should certainly think about new products. That will happen in the next stage. The products could be multiple types, as you would appreciate. They could be strategy-based products, they could be index-based products, or they could be stock-based products. The sky is the limit, as you know, in terms of thinking about products that can be useful to the market. It's also very important to find out what the market wants. It's not that, no, what we can introduce, which is voice of customer I always have been embarking upon. So we will be seeking the views of the customer once these two products sort of stabilizes, and then whatever the market feels that BSE should do, which will be useful for them, that's what we will do.
Okay, just quickly, sir, you know, the SME segment has seen a lot of action this year. How significant is it in terms of a contribution, and what might your outlook be on it going into next year?
Very, very good question. SMEs are a segment which is very close to my heart for various economic reasons, as I've always been talking about. My honest reply is, I don't think we have made any dent into the SME sector. We talk about having around 500 companies listed, but that is, I think, a drop in the ocean. There are a lot many more good SMEs in the market who need to be supported, who need to get listed, who need to get visibility, who need to get access to finance in a simpler way. I think our entire goal in the coming years and months will be to approach more and more SMEs to find out how we can help them. I think it's not actually in terms of what it contributes to the bottom line, it is becoming important. Honestly, it does not contribute much to the bottom line. I don't look at it as something which is going to contribute to the bottom line. It is more as a national service. It's a duty of a MII like us to get to SMEs to help them, because they are backbone of our economy.
All right, and finally, before we let you go, sir, you know, it's been a big wealth creator, like we've pointed out. Let's talk about good old cash market as well. I remember, you know, we speaking for the first time when you took over, and you said your immediate goal in the cash market is to get to the 10% market share mark. As we speak, it's close to around 7%. So by when do you expect it to go to 10%? How does that pan out? And secondly is the cash that sits on BSE's books. What are your plans with that?
So on the first point, even I do not know when I will reach the 10%. The institutional participation in BSE is abysmal. The domestic institution need to consciously think about concentration risk and start giving some amount of volumes into BSE so that there can be an organic growth of all the institutions. We are working on it and we wish it happens ASAP. As far as the cash is concerned, MIIs like us should have a good amount of balance sheet, as you know, to support ourselves in terms of any exigencies. Having said that, we are also embarking on multiple avenues of investment which can strengthen BSE from the cash that we have. For example, we are into big resource building, be it human resources, be it technological resources. Because if you are growing volumes today, technology is the backbone. We are in that sense a fintech company, as you would say, whether we want to call it that way or not. Therefore, clearly, building technology resources is very important, where we are putting in a lot of money and effort and time. And also, we are investing in, see, for example, in Gift City, we have made a sizable rights issue contribution to the budding and upcoming ONDC, where we can have some benefit and synergies. We have put in some money through our BSE investments. We are also looking at avenues which are synergistic to the existing business of us, where if we invest money, it will be a long-term goal for BSE.
All right, sir. It was great speaking with you. Thank you so much for joining us on CNBC TV18, and it's been a big, wealth creator, and of course, you've generated a lot of money for shareholders as well through your platform. So thank you so much for speaking to us, and all the best for the new year. All right.
Thank you so much, and Happy Christmas and Happy New Year.
Merry Christmas to you too. Thank you, sir. Well, let's move on. The market is having a very Merry Christmas, it seems. Look at that, 125 points higher, not giving up on any of its gains. A big winner of 2023 is Zensar Technologies, and the stock has seen a stellar move, 182% move this year. In all the stock of generative AI, Zensar Technologies is also doing a lot in this space. So let's get straight to that. Manish Tandon, the Managing Director and Chief Executive Officer at Zensar Technologies, joins us now to talk about that. Manish, thanks a lot for joining in. You have done 100 proof of concepts for clients on generative AI. You know, we were just having this conversation with Happiest Minds yesterday, and they told us that 20% of their revenue can come from generative AI products and systems in the next 5 years. What is your own opportunity here, and what kind of trajectory are you looking at?
I think it will depend on, see, we are in the services sector. It will depend to a large extent on the acceptability of generative AI in the larger market, in the domains that it is successful. And I would say 20% is a good estimate overall if the technology really takes off. Although I can tell you a word of caution, it's still early days for the technology.
Okay. All right. Well, one of the things which have really stood out for your stock, which has in fact risen around 180% this year, so congratulations on that. But nonetheless, in terms of your margin improvement from Q2 of FY23, 8.5% to all the way to 18.6% in the quarter gone by. What can you guide on in terms of margin, say, for the second half of the fiscal? What would the exit run rate be, and what is sustainable?
I think, first of all, we don't provide guidance, but our goal is to maintain mid-teen margins. Currently, we are running a bit higher than that, and that gives us the flexibility to invest in the business, invest in our employees, and invest in our clients, invest in sales, invest in getting large deals. So we are looking at maintaining margins in a narrow band of mid-teens.
All right. Is there any aspiration that you have as far as revenues are concerned? I mean, you're doing about $600 million annually. The $1 billion mark is something that every company looks at. Do you have a sense of when you want to get there by? And how has demand generally been in the near term for you to be able to get to that $1 billion mark in the medium and long term?
That's a very good question. I'm just glad you're not on my board because there I keep getting asked this billion-dollar question. And I can say that as a company and as a CEO, I'm focused more on profitability of the company. Ultimately, all the valuation models that you see out there, they are not dependent on revenue growth. They are dependent on EPS growth or cash flow growth. And that's what we are focused on. So even in this environment, if you notice, our bottom line PAT has gone up by close to 66%, if I'm not mistaken. And that is what we will continue to strive to deliver value to investors. See, it's easy to get revenues with zero profitability. I mean, you can just do a lot of pass-through revenues and get to $1 billion, but again, it's meaningless. It's about how you get to that. What is the profitability that you generate is extremely important.
It's interesting you say that because, you know, if you map what's happened in the last couple of quarters, right, the industry has not signed any large deals, especially in Q3. Do you think that is just lumpiness, or is that something that can continue? I ask also because Accenture in their latest release spoke about muted demand environment. They spoke about the deal wins not being as strong as what it was before. Your own thoughts on mega deals?
See, mega deals and large actually deals are happening, but for every 1 or 2 deals that happen, equal numbers get cancelled also. So I would say that the market continues to remain very tough, and there is a disconnect between what you see in the stock markets and what you see in the real economy. I know stock markets are supposed to be looking at the future, so hopefully the future is bright. But I can tell you that here and now, the demand environment is pretty tough. We have a lot of exposure to high tech, and I can tell you that at least this quarter, the furloughs are deeper and broader than what I have seen in the past.
Okay, but Manish, do you expect this to change, considering that, you know, IT companies have seen different cycles, and next year we're expecting the Fed to probably cut rates, so that should probably fuel a softer demand or better demand environment rather. In that case, what is your outlook when it comes to demand, discretionary spend, decision making going into next year?
From my perspective, it is not just about interest rates, it's also about the excess liquidity in the system. Today, as you know, the Fed balance sheet is still at least twice the size it was before COVID. And I think that is also causing some of these asset bubbles, which are yet to be pierced. From an industry perspective, yes, if interest rates come down, then we will see more capital investments and more discretionary projects will come into play. But again, remember that interest rates will come down if the economy doesn't do well. So that also one needs to bear in mind. Sometimes, I mean, you get what you ask for, right? So that is something that that one needs to look at.
All right, take that point. Thank you so much, Manish, for joining in. And you know, you've had a Midas touch on the stock ever since you've joined the company, the business, the stock price, margins have reached to mid-teens, etc. You expect it to stay there, and then the next time we meet, we'll again ask you that billion-dollar question as well. Take a short break, come back, and on the other side, we will talk pizzas. Our exclusive conversation with Sameer Khetarpal, who is the MD and CEO at Jubilant Foodworks, on Domino's new brand campaign and the company's demand outlook post their World Cup. Stay tuned.
CNBC-TV18, embarking on a quarter century of excellence.
Co-presented by
CNBC-TV18, embarking on a quarter century of excellence.
Welcome back. Well, Jubilant Foodworks is on our radar now. Domino's has launched a new brand campaign. It happens only with pizza. Mangalam caught up with Sameer Khetrapal, the MD and CEO at Jubilant Foodworks, to discuss the new brand campaign. How is the pizza market shaping up in India and the company's demand environment? Listen in.
So I think it is good. I think we are in our busiest quarter of the year. Diwali followed by Cricket World Cup, and we are gearing up for big days, as we call it internally. From 24th of December to 1st of January is really crazy time for all stores. So we're all geared up, ready to serve hot pizzas in 20 minutes.
Pizzas in 20 minutes. How has demand been in the World Cup? And if you could, tell us, the first half of this year, there was a sluggishness in the overall QSR industry itself. How has that picked up in the third quarter for you?
So I think we are seeing three very distinct, behaviors as we speak. So firstly, our big days are becoming bigger. The Diwali this time was bigger than the last Diwali, and then the World Cup final was bigger than Diwali. So I think we do see consumers coming out and spending more on big days. That is naturally happening. But on the whole, I think there is propensity to conserve, propensity to downtrade, propensity to I think from an overall sentiment standpoint, it is not back as we would have liked it to be. But big days are getting bigger, ticket sizes are beginning to improve. So on the balance, I think it augurs well for the industry overall.
So do we see positive like-for-like growth in the second half of this year?
I think yet to say. A lot will depend upon the last few days, actually. These are really material needle movers for us. Also, Diwali last year was in 2022 was in October. It's in November this year. So it all depends upon December, how the last 15 days go. So we are banking and geared up for it, Mangalam.
All right, let's talk about pizzas as a category itself. Sameer, while a lot of people are eating a lot of pizzas, the World Cup that you spoke about, we ordered nearly 188 pizzas per minute on the World Cup final, as aggregated by one of the food delivery apps itself. But pizza as a category over the last couple of years has slowed down in comparison to its other snacking categories like burgers, sandwiches, etc. What do you think has happened here, and what are you really doing to reignite that appetite for pizza?
I think here we are announcing the launch of It Happens Only with Pizza. Just to step back, Mangalam, also for your viewers, overall Indian food service market is $50 billion. And pizza is the largest QSR food over here, or category over here, with about 900 million or about less than $1 billion of category share. Now, in $50 billion market, the job for the largest QSR is to win share of occasions. When a customer is wanting to eat a vada pav or a dosa or a bhatura chana, that is where the large market is. And if it happens only with pizza, we are positioning pizza and therefore Domino's as front and the center to gain that mind share, to win in those occasions. When a customer is wanting to order something which is mood uplifting, craving, it's pizza right over there.
That's an interesting proposition out there. But in pizza itself, is Domino's still leading the category, or are we seeing some heat coming in from other local national players as well? They've multiplied quite a bit. I mean, to name something like a Pino's, etc. as well. They've been doing extremely well in a lot of geographies.
So firstly, Mangalam, all our indicators tell us that we are gaining share. I think there are publicly listed companies, and there are, of course, we track a share of our number of stores and the throughput per store by region. So very well corroborated with external data and our own internal research, we are gaining share as it, and it's natural in this kind of a little bit of a sentiment slowdown. The leader actually tends to gain more share. To me, you mentioned a few names. These are actually category builders. There's a reason why pizza continues to be the largest QSR category in India. And in that sense, India is kind of an outlier because I believe pizza is something where Indians will own it. It has already become part of the Indian palate. It has already become part of Indian verbiage. So competition coming in is expanding the category. And just to give you some numbers, pizza eating frequency in India is only 3 in a year. In US, it is 35. So imagine the headroom. I'm not saying we're going to go to 35 in the next 2 or 3 years, but the journey of if this 3 goes to 4, look at the massive amount of, we will be selling millions of pizza, we need more competition over there.
All right, we get that. Take that point. Let's talk about business itself right now. If India has such a big opportunity, what propelled you to increase your stake in DP Eurasia and perhaps make that open offer out there as well? This is a trend that we are seeing across a lot of the QSRs which are chasing growth outside of Indian shores. What exactly is happening there, and what's your plan itself with DP Eurasia?
So firstly, we are in a bit of a silent period. I will not comment too much on the strategy of why we are doing this, and we'll come back to you, Mangalam, at the right time when some of these open offers have closed down. Having said that, till almost a month ago, we had nearly 49% stake in DP Eurasia. So the natural outcome was or logical conclusion was to fully own the company, consolidate. And our endeavor is to delist the company from the London Stock Exchange, right, and make it private and consolidate. We understand pizza as a category. Turkey as a country behaves very similar to India, very price conscious, a big QSR market, and Domino's over there is the leader in pizza as a category.
You had said that, you did see the average ticket sizes increase when it came to pizzas. You had taken massive price cuts and given a lot of offers to consumers as well. What has the realization growth been according to you? And have margins, begun to inch back to the historical 25-26% mark levels?
So firstly, we have reduced our discounts. We have not increased our discounts. Through data and technology, we are now able to sharply target consumers who are more discount seeking versus who are more convenience seeking and who wants more gourmet pizzas versus a 49 rupee pizza. So we have a lot sharper in our discount targeting. So that's one. Therefore, our discount percentages have come down. And if you look at our results, Mangalam, for the last 2 quarters, we've in fact expanded gross margin. And discount is an integral part of price realization that we get per order, and therefore our gross margins have improved. We invested a lot of that gross margin into expanding our organization. We moved from 4 regions to 7 regions. We are now geared up to really build this 3,000 store organization in Domino's with 7 regions, with very, very sharp and very highly qualified regional managers who bring in a mix of both physical and digital retailing prowess to run our 1,000 crore businesses that each of this region will become.
On store expansion itself, a lot on the street are worried about you increasing your fixed costs at a time where demand environment is a little weak. Do you think that could be a problem in the near term for you to be able to sweat these stores that you're opening?
Not at all. I think there is enough opportunity, firstly. I do believe this is, when the demand sentiment is low, if you execute well, things like 20-minute delivery, 49 rupee pizza, having a strong app and your own delivery capabilities, or going to tier 3, tier 4 location allows us to, in fact, actually sweat our assets.
All right, I won't let you go without a number on this one. This year, okay, there is still time for you to understand what is happening. Next year, what is your LFL target with the kind of expanded store base that you have?
See, the rightful growth for us, Mangalam, as I see it internally, I'm not giving a guidance, but I'm what we internally aspire for or rather work towards is typically we should be in 2 to 3% like-for-like growth, and 10% store addition should give you to anywhere from 12 to 14% is what my teams always focus on.
with margins between 24 to 25%, or maybe structurally
margins upwards of 150 to 200 bips from here. If the like-for-like growth comes in, right, there is no reason why margins will move.
All right, let's move about beyond from pizza and talk about Popeyes as well, because that is another growth vector for you. And as soon as I say Popeyes, you smile. 22 stores is what you're at right now. By when do you get to another milestone, and what's the growth target that you have for Popeyes in the next say 18 to 24 months?
On Popeyes, what I can assure you, Mangalam, is we will be the fastest QSR to get to 1,000 crores in India.
And by when does that happen?
So I think for an average, if you look at the brand that have crossed 1,000 crore, including Domino's, it has been a 12+ year journey. We should do it in a fraction of a time, maybe a third or in anywhere between 3 to 5 years, we should get over there.
You whetted up appetite with Popeyes. You've spoken about the pizza. It happens only with pizza. But what about Hong's and Dunkin'? You have plans for that? Because you had told me earlier that, you are looking at only few growth vectors and not spreading too thin. So will you look at growing these two?
My priority, in the near term, remains tripling down on Domino's, scaling Popeyes to 1,000 crores, and building a outstanding team and a culture that can last for a long time. So these are my top 3 priorities. I treat Hong's and Dunkin' more like startups. They are organized, they're funded for their immediate needs. And as they gain customer traction, prove their economic model, they get the next round of funding from us.
Okay, just take a look at the new listings. Dom's is flying off the shelf. I mean, there was an expectation it would be a good listing, but it's listed at a premium of 77%. Remember, there is a lot of euphoria in the market with respect to IPOs, so let's not forget that. But even India Shelter, firm listing seen over there, premium of 26%, but Dom's really takes your breath away. And with this, let's not forget that I don't know what the definition of expensive or cheap is now anymore in terms of stocks, but just to compare it with their peers, right? Dom's is now trading at about 50 times compared to listed peers like Kokuyu Camlin or Link. Kokuyu Camlin is trading at about 64 times. Navneet Education trading at 16 times. Of course, not strictly comparable apples to apples, but nevertheless, Dom's having a phenomenal listing there, 73%. Who would have thought, right? A pencil manufacturer, a stationery manufacturer listing at such a big premium.
But it is so top of mind in terms of a brand that it's overtaken everything else which is available. If you just see it, my daughter's entire stationery box is just filled with Dom's, and that's what you exchange on birthdays, etc. Just to put it into perspective, and this is from the CNBC-TV18 website itself. For a 1,200 crore IPO, Dom's ended up receiving bids worth 65,000 crores. So that's the kind of interest you've seen for this particular IPO. I think it's just so in your face. It's something that you can touch, feel every day. And I think that's what's really, that's what the investors have really liked about it.
It'll be interesting to see whether they continue to hold their market share or not, because when we were children, we used other brands, and now it's Dom's. So brand mortality in this segment, because it's so competitive, is extremely high as well. That's Dom's for you right now, 73% higher on listing. Take a short break, come back, and we discuss. All right, before we do that, let's go across to Mitesh as well. Mitesh, first hour of trade, been very, very good, almost 100 points on the Nifty, mid-caps doing even better. What would your call be?
So I think, the start is very good. We've slightly tapered off from the highs, but the directional bias remains on the upside. So I have 2 long calls right now. Sun TV is something, which is broken above this level of 700. So that's a fresh swing move happening over here. Buy with a stop at about 698, look for targets of 750. And the other one which I like is Crompton. That's trading around levels of 303.5. So that's a buy with a stop at about 298 for targets of 315.
All right, let's do one thing. Let's take a short break on that note. On the other side of the break, we'll put focus on the commodity markets. Manisha Gupta will be joining in. Stay tuned.
CNBC-TV18, embarking on a quarter-century of excellence. Muthoot Microfin Limited, a microfinance institution from TV18, embarking on a quarter-century of excellence.
All right, let's shift focus to the commodity markets now. Manisha Gupta is joining in. Manisha, what's the one commodity that you're looking at today?
So now I'm looking at copper, and the focus clearly seems to be shifting towards 2024 and the kind of fundamentals and facts that we would see in that year. But starting off with the price moves itself, we are trading at a 19-week high. So the copper prices have continued to gain on concerns of mine closures and disruptions that the street is already looking at. So you have the Panama government ordering closure of the first quantum Cobre mine. This is what produces 1% of the global copper supplies come in from here. So that is what you are seeing in sense of premium. Not just that, you have had statements come in from Anglo American and Brazil's Vale saying that they are looking at lower production guidance for 2024 and 25 as well. Anywhere between 16% to 20% of a cut in production is what we are looking at for 2024 and going ahead. Also adding some more premium to prices is the statement from Australia putting copper on essential material list to global energy transition. So those are some of the facts that have been keeping the prices on the higher side. Macro in any case has been stronger because you're looking at weakness in US dollar index, expectation of rate cuts going forward, and then the hedge fund buying also has been supportive. On CME, the shorts have been cut from 76,000 contracts to almost 46,000 contracts. We have seen a similar mirroring effect coming in from LME as well. Here as well, the short positions have been cut from 47,000 to 25,000 contracts, telling you that the markets are buying back into this space and there are long positions or accumulations as well being done at this point in time. Talk about Outlook 2024, and there are reports already from BMO Capital, Goldman Sachs and Jefferies talking about a deficit going forward in case of copper in 2024. Well, if you remember, the deficit has been on since 2019. The street was anticipating that in 2024 you could be looking at perhaps new projects coming online, but that really seems to be fading right now. And then apart from that, the China stimulus, US rate cuts, all of that has been a supportive factor as well as we end this year and get into the next one as well. The markets also have put out some price targets here. So Citi clearly has been the most bullish. They're talking about an all-time highs in case of copper by 2025. The all-time high until now for copper has been 10,700. They are talking about levels of $12,000 to $15,000 per ton there. Commerce Bank is talking about 9,400. We are trading at 8,500 right now. So these are still bullish targets there. But there's also a report come in from ING where they feel that an average price for copper next year could be 8,600. So it clearly is all over the place right now. But at this point in time, there are accumulation levels that you have seen for copper and copper-related equities.
All right. Well, thanks a lot, Manisha, for that. Let's do one thing. Let's take a quick commercial break, but not without showing you that the market continues to hold on to the 21,500 mark. On the other side, our special segment, It's the Economy. Lata will get chatting with S. Srinivasan, the Managing Director at Kotak Alternate Asset Management, to discuss the tightening of the AIF investing rules by the RBI and what this means for the sector.
CNBC-TV18, embarking on a quarter century of excellence.
Co-powered by